in the last couple of trading sessions, both locally and globally, markets have been slightly volatile, whereas bulls are insisting that it's a brute force of liquidity which will take care of all the imbalances. The bears are also coming back, and their striking point is that bond yields are inching higher and global productivity is yet to pick up. So let's connect the dots. Let's talk about valuation, sector and some mega trends with Abhay Laijawala of Deutsche Equities. Fantastic to have you back on ET Now. Thank you for joining us.
Thank you.
We are potentially staring at some market moving events, whether it is politics or policy action from central bank. As of today, global volatility is missing. Do you think there is a lot of complacency in the system?
Absolutely. There is a huge amount of complacency. If you saw that the VIX had reduced quite significantly, and in the last couple of days we've seen volatility come back. And one of the key reasons for this repressed volatility has been the near one-sided view that central bankers will remain accommodative. So the liquidity argument alone cannot be the basis for investing. And because this feeling, this belief has been so one-sided over the last couple of years that, this thought is keeping markets very buoyant. But think about it, when all bets in the world are literally one way, when different asset classes are correlated, and if things in the world shift, then all those one-sided bets could start to come off. And that's the risk that we need to be concerned about.
So is one better off raising some cash? You may run the risk of underperforming because the short term you're betting against the momentum, but do you think that cash call eventually will pay out?
I think the best strategy right now is, if you can be in cash, that's a good strategy, but otherwise adopt a defensive posture. So for international investors, they are looking more at relative performance, and a defensive posture could give you better relative performance. If you are worried about global volatility in the next 2 to 3 months, then I guess moving a larger allocation to cash would probably be a good strategy. Whichever way, we are advocating a defensive stance on the markets. And in fact, we have a Sensex target of 27,000 for December. We slashed this immediately after Brexit. We had a target of 29,000, which we slashed to 27,000, and we remain concerned.
So as we wrap the year, you expect markets to come down?
That is the view, because as I mentioned earlier, there are more headwinds than tailwinds as we head into the end of the year.
But some would argue that the only risk for India is actually valuations. Globally, things are, they may move this way, they move that way, it's hard to predict. But when it comes to India, it's never been that clear, it's never been that good.
I agree with you, but the fact of the matter is that we are part of the emerging market universe. And even more importantly, local institutions in India, our domestics, have about 7%, 8% of the market, whereas the foreigners, their proportion of the market is about 21%. And the worries are more macro. So if there is any macro-related risk that leads to emerging market outflows, the domestics will not be able to keep the market standing, and the market will turn volatile in response to the EM outflows. Otherwise, completely agree with you. In fact, we are telling investors that the Indian consumer offers the best hedge in the entire emerging market universe.
Your strategy report seems to be making a case that earnings trajectory will only accelerate. In fact, you are pricing in almost a late teen kind of an growth for FY18. Now that means you are really confident about the economic recovery and the earnings trajectory.
Absolutely. And that is attributed to a whole host of factors. We think that beginning the next 3 months or the next 6 months, we are going to see a very positive confidence shock to consumption. the synchronization of the pay commission recommendations, the salaries coming into the accounts of public sector employees just ahead of the festive season, just 2 months before the harvest, then a very good harvest. The government's advance estimates are putting the Kharif crop at a record 135 million tons, and you're seeing a significant boost to liquidity. Beginning next year, we are probably going to see round 2 of the pay commission benefits come through as the state governments start to raise their salaries. Now remember, just the central government boost is as significant as 110,000 crores without the multiplier impact. If you add the state governments, and it depends on how many states are going to raise it, I would expect that most of the states will raise it. So we are talking of a 2-year phenomenon where you get close to 0.85% to maybe 1% of GDP coming in as a consumption boost without the multiplier impact. Liquidity is benign, interest rates are falling. As a result of that, you are going to see consumption come in very significantly. And let's not forget a very important fact, that in the last 2 years, rural consumption has been extremely low. Urban consumption was driving the economy, and now we have the twin levers of rural and urban consumption coming through, and we should not ignore the potency of that combined boost to consumption. That's the reason why we remain extremely confident. Unfortunately, we think that the private sector capex cycle is probably still some time away. So the growth, the economy will be boosted only by consumption, neither by exports nor by private sector capital formation.
You know, money is made when you are able to identify mispricing. If you sell higher, where you make money by going short. If you buy lower, if you're able to identify earnings curve ahead of the time, you make money by going long. So in this kind of a market, where do you think markets are still mispricing growth? A, on the high side, and B, on the lower side?
Interestingly and ironically, consumption. And the reason why I say that is we see a very reasonable chance of consensus upgrades coming through in the consumer interfacing sectors.
Give me an example. When you say consumer interfacing, what do you mean by that?
Interesting. Okay, I'm glad you asked that. I think consumer interfacing sectors include everything ranging from consumer staples and consumer discretionary to retail-focused banks, NBFCs, and even the oil marketing companies. So this entire range of sectors, discretionary, including tractors, automobiles, two-wheelers, oil marketing companies, retail-focused banks, NBFCs, we think that there could be a serious risk, upside risk to consensus estimates. And we highlighted, this through a report we wrote, where we had said that in FY11, when the economy had a similar boost due to a monsoon after a long drought, you had seen big increases to consensus estimates. Now, there were other factors at that point in time. You were coming after the global financial crisis. The government had given a boost to the economy. Interest rates had been cut. But even if you strip all that out, it does demonstrate that there is a certain degree of rural demand which is yet being underpriced by the street. And I think that's what will drive the earnings. Now, does that happen in the December quarter? Does that happen in the March quarter? Is difficult to say, but I remain extremely confident that we will be exiting this year with consensus earnings upgrades for these sectors, probably for the fourth quarter and definitely for the next year.
But the scope for P expansion in a HUL or HDFC Bank or Maruti now is limited. So one would argue that now the appreciation would be in line with earnings estimates. And the earning estimates, well, they could vary by 5 or 7%. You may get it right, you may get it wrong. That's debatable. But it's not that earnings will grow at 50, 60%. So some would argue that the real trailblazing move is behind us.
You could say that. You could say that. And I think the move has indeed been trailblazing, as you say. So that is possible. I think we have to prepare ourselves for subdued returns in India. When we talk of India, everyone thinks in India all the returns are always double digit.
Exactly.
And I think we have to be realistic that you can't have trailblazing returns in all sectors at all points in time.
Where are you on this mid-cap versus large-cap debate? Historically, mid-caps, they trade at a discount to large-cap. But in India, you have a situation where the tail is wagging the dog is not wagging the tail. And I'm sure your clients are asking you, Abhay, let's talk about buying some mid-cap names, give me new ideas, let's go down the quality curve, that's all right, but I want alpha ideas.
No, very, very true. This is in fact a question that is being asked by all the investors, and our response is that you should be careful now. The mid-cap index is trading at close to a 25% premium to the large caps. I can't recall the last time this was there, at least, so that means it's definitely not been in the last 8, 9, 10 years. So a significant amount of froth may probably be building in the mid caps, and this could be attributed to the fact that a lot of domestic money has chased the mid caps because the retail investor is more comfortable with mid caps, and therefore the retail flows which have gone into mutual funds have gone into those schemes which are invested more in the mid caps. So at some point in time, if you believe that retail flows slow down, then automatically the adjustment will come through. But we are now beginning to get concerned that in the mid cap space, valuations are beginning to look very frothy. In fact, many of the companies that we earlier defined as mid-caps are no longer mid-caps.
They become semi-large caps, almost large caps now.
Exactly. And finally, there is, as I keep saying, finally there is a sanctity to valuations. And however strong the business case, if the valuation just doesn't justify it, then I guess we have to be extremely vigilant.
Before I throw it to you for your response, as an individual, my life is getting more automated. I'm using more technology, and I will continue to use more technology. So if the big picture for me is that my life will get more digital and more towards IT-oriented lifestyle, why should I be bearish on IT?
No, very good question. The problems, or rather the reason why most houses, including us, is underweight in IT are cyclical and not structural. The reason why we have gone underweight in IT is because there are concerns with regard to the banking and financial services sector, which has been impacted over the last couple of months, particularly on account of a flattening yield curve, on account of negative interest rates, which have impacted your net interest margins, all of which tends to result in discretionary IT spending getting impacted. In addition, we still have some shorter term headwinds. As I said, we are headed into the US election, and anti-immigration rhetoric tends to be very loud ahead of almost all US elections. So I guess we've got to cross that bridge as well. So once I guess we have some comfort over these factors, perhaps the market will start getting comfortable. Now, one more thing I would like to state over here is, if the global yield curve starts to steepen, the perception will be that this is going to finally be positive for the global banking and the global insurance services industry. At that point in time, you could probably start seeing demand for IT sector beginning to look buoyant once again, because the perception will be that discretionary spending could return as NIMs or the NIM compression worries erode. But don't know when that's going to happen. We need to watch that very carefully.
As a house, you're bullish on oil marketing companies, and that's been a bullish call.
I don't think we are positive. We are very positive.
You're very positive.
And we were amongst, I'm very proud of the fact that our analyst, oil and gas analyst Harshad Katkar, was ahead of the curve in predicting many of these names and the upside, and he called this with very high conviction.
And you think the springtime is not over?
Not at all.
Why is that?
Not at all. The reason is that these stocks are now being seen as consumer companies. These stocks are not necessarily just basic material stocks or energy related stocks, because 50% of the demand for these companies, 50% of the earnings for these companies comes from marketing margins. And with Indians driving more, with increasing road connectivity, both diesel and petrol consumption is breaking all records. So in India, our diesel and petrol consumption are growing 6 and 10% on top of the all-time highs. And we think that this trend will continue.
So if you have to, let's say, choose between autos and OMCs, which way would you lean?
I think my analysts will be very unhappy if I choose one over the other. But I would say both, because both are correlated. Though within auto, I confess that we prefer two-wheelers more on account of valuations than the four-wheelers. So we prefer two-wheelers and we like tractors.
The street is still divided on how to value PSU banks. Let's be real, the write-off has been very sharp. The drop in the 10-year paper will boost their treasury income very smartly, at least in this current quarter. Markets, they simply love to hate them. You like SBI, and that's the only one which you like. But apart from SBI, is there a case to buy PSU banks?
Under the SEBI rules, I won't be. I'm not permitted to speak about individual stocks. But earlier during this conversation, you asked me, where do we see value in the Indian market? There is value in selective pockets in the PSU bank space, but stock selection will be the key over here. We were in Europe recently, and we were highlighting this view. And for the first time in 2 years, there was no pushback. Investors, in fact, wanted to, listen to the view why we are going out and saying that, some PSU banks have deep value. And there was a very healthy conversation. Up in the last 2 years, conversation used to move on. No, we don't want to discuss the PSU banks. We think that the NPL cycle, etc., is going to take a long time to resolve. Credit costs are not going to come down in a hurry, and we are worried about the book. Now, the questions that are coming is, do you think that a large part of the NPL recognition is done? What do you think is the trajectory for credit costs? And the most important question, and the most common question across meetings, was, how much do you think the treasury gains can help repair the balance sheet? So we were in fact highlighting to many of these investors that we had a very similar situation in 2002 and 2003, when you had a big accretion to NPLs, and then when the RBI cut interest rates and bond yields came down, in those 2 or 3 years, the public sector banks massively repaired their balance sheets. And I think that's what we are witnessing right now. Liquidity is extremely benign. You've already seen 90,000 crores of open market operations. And the governor, who was earlier the deputy governor, and when he was the deputy governor, he'd said that we are only 50% of the way done on our liquidity injection targets. So if 90,000 crores is 50%, and we are going to see another 50%, then I think we could probably expect an equally fast-paced trajectory on the treasury bonds.
So if you, let's say, have to make a basket of the 2-3 large retail banks, the obvious ones, and 2-3 large PSU banks, the obvious ones, as a basket on a 2-year basis, on a 3-year basis, the wholesale bank basket or the retail bank basket, which will outperform?
I think the basket should comprise both. Because, there are certain private sector banks where there is still value, which are highly retail focused, and where earnings growth will be very sharp on account of this, consumption boom that we are going to see. And there are pockets of value on so the basket will have to comprise select names from both, including NBFCs.
Why NBFCs? I mean, that's the toast of the town right now, but I mean, the price multiples just surprise me.
But I agree with you, but there are still some NBFCs where there is valuation support. So I agree that most of the sector is looking very rich, and we have downgraded some of the names as well to holds, but there is still value in some names which figure in our model portfolio for India.
Let me take the clock back and then I'll rewind it for my last question. Exactly a year and a half ago, there was a cheery consensus around Indian pharma. The view was that nothing could go wrong, and these companies will continue to multiply because the US generic market size was so large. But today, as we stand, there is a price erosion, there is a manufacturing problem, and there is a US FD overhang. Is it time to be a contra buyer there?
So pharma, in fact, is an overweight in our model portfolio. So we do believe that perhaps the concerns over FDA were excessive, but at the same time they are realistic, they are legitimate, and therefore stock selection again will be the key. So in our model portfolio, we have those pharma companies where we believe that the risk of FDA, the negative risk of FDA action is low. So those are the companies, and there are companies where we see other catalysts. So between these two criteria, the low FDA risk and other very solid catalysts, we like those sectors. Once again, stock selection will be the key. And as the market gravitates towards a defensive posture, we do believe that overweights for pharma by the street will move even higher.
Okay, let me take the clock forward now. My last question. A year from now, which is let's say September 2017, if we are sitting on the same forum, having an engaging conversation, what kind of market do you think we could be staring at? I'm not getting into levels because you don't have house view on levels, so let's not get there. But in terms of the general mood point, the trajectory, where do you think we are headed?
Definitely higher, because by
That's
that time, no, I think let's go by the earnings expectation, right? So if earnings are going to expand by anywhere between, so you're referring to FY18, I presume?
FY18.
I think FY18 could potentially be the best ever year for India in terms of economic growth and in terms of earnings, because a lot of reforms that this government has made will begin to start coming to fruition. The lower interest rates will start to result in stronger consumer demand. The monsoons, a positive confidence shock. And I do believe that by FY18, we should probably see the beginning of a capex recovery. And I think one of the biggest sectors that we are going to see benefiting from many of these changes is the small and unorganized sector. So that could provide an additional boost to the overall economy. So barring any global risks, if we are just talking of India, then the markets could be far higher. And as I said, if earnings growth in FY18 is going to be 17 to 18%, then I think the trajectory for the market looks very good at that point in time.
Secretly, I was looking for that punchline that we will be headed higher. We may have started on a slightly somber note. We talked about global cues, but the eventual view is that buy dips, participate in Indian equities, and believe in the magic of compounding, because the stars are currently perhaps aligning for us.
Absolutely. But in the short term, I would say the concerns are equally worrying.
They're real and they may haunt us because excesses currently have got big.
Absolutely.
Appreciate your time and thank you for joining us.
Thank you.
That's it on this edition of Market Makers. Thank you for tuning in. Thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.